Hi, this is Diane Kennedy. Welcome to today's online workshop. Today I'm going to be talking about C corporations. We've been talking a lot about business structures as I'm doing these different online workshops. Well, the C corporation is a structure that's been around a long time. In fact, I think I'd have to look it up, but I think it's been around longer than any other type of structure that we've got. And as a result, over time, they've kind of come in and out of vogue. So let's talk about some of the myths that are around the C corporation. It almost seems like there's this dichotomy. People love them or hate them. Now, if you hate them, that means you're probably thinking of issues like double taxation. You might have heard this before. It's like, oh, if you get a C corporation, you're going to pay twice the taxes. But nobody ever really stops to think about when that actually occurs. So let's talk about that right now. Does double taxation happen in a C corporation? Absolutely. It happens when the corporation makes income, and from income you take your expenses, and then you pay tax on what the taxable income is. In this case, because it's a C corporation, it's going to pay tax based on what's left inside that corporation. But then let's say you want to pay yourself some money. Now, if you pay yourself salary, it's going to be a deduction for the corporation. So the corporation won't pay tax on the amount that's paid to you in salary. Or let's say you take some tax-free benefits. Tax-free benefits. That means you don't pay tax on these at all, yet they're a deduction for the corporation. That's the opposite of double taxation. That's no taxation at all. That's tax-free. But where does the double taxation actually occur? It happens when you pay a dividend from the C corporation. Now, if the C corporation pays you a dividend, it pays tax first on the income and then pays out the dividend after tax. And yet it's taxable for you. That's when you have double taxation. Now, how do you resolve the issue of double taxation? I bet you know the answer to this. Don't pay a dividend. And that's the bottom line answer. If you're not paying a dividend, you don't have an issue with that. So that's one of the common issues that people get concerned about a C corporation. Now, I don't advocate a C corporation in every instance, but the reason not to have a C corporation is not because of double taxation. And boy, I had a bunch of negatives there. Let me say this a different way. Don't be concerned about double taxation. That shouldn't be the reason you don't have a C corporation. Instead, you might want to not have it because of personal holding company, consolidated group issues, because of a personal service corporation. These are the legitimate reasons for not having a C corporation. Now, let's go to the other side. There's groups of people that love the C corporation. Why do they love them? Well, it's because of those tax-free benefits that I was talking about. You see, you can get better benefits from a C corporation. Now, this is the part that's tricky. Is it worth going through the added expense and hassle of having a C corporation? Perhaps. For example, I had one client who he was a high-income earner and through his businesses, and he was also helping pay for his mother-in-law's medical expenses, which were a lot. Well, they tried to find a way for how can we turn that into a before tax issue. Well, it was easy. They formed a C corporation, and his mother-in-law became a legitimate employee doing tasks inside that C corporation. As soon as they did, the C corporation can set up what's called a medical expense reimbursement plan. And with that, all of the medical expenses then became before tax expenses. Now, there's a lot of other things that go into determining that kind of plan. You've got to make sure you don't have control group issues. In other words, you can't just go set up another C corporation when you have a bunch of employees in another company and you have the same or similar ownership. But we made sure all of those things were set up correctly in this case. And as a result, they got to take a big deduction for something they were paying for after tax. Now, if you have a few $1,000s worth of medical expenses, it's probably not worth it to set up a C corporation. But one additional reason you might want to do it is if you have a lot of income. If your income's over $250,000 a year, for example, you're at the highest income tax bracket there is personally. If we could take some of that income that's at that highest bracket, which is now 39.6%, and move it over to the C corporation, it'll be the first $50,000 will come from 39.6% and move to 15% inside the C corporation. That's a big savings. So those are some of the reasons you might want a C corporation and some of the reasons you might not want a C corporation. I want to thank you for joining me today. This has been Diane Kennedy and your online workshop.